Today is March 19th, 2026, and gold is sitting at $4,126 per ounce, down over 5.5%. Silver, the metal that you and I have been tracking together on this channel, has been absolutely hammered, down nearly 9% on the spot price, touching $70.81. Silver futures crashed as much as 12% intraday, settling near $68.31. If you close this video right now, you will miss the single most critical piece of analysis I have ever delivered on this channel. This is not a drill. This is not clickbait. The move happening today in XAG USD and XAU USD is the kind of price action that either destroys accounts or builds generational wealth, depending entirely on whether you understand what is actually driving it. So do not touch that back button, because in the next 20 minutes, we are going to break this entire market wide open. I am JIANG, and welcome back to Silver Signals, the channel where we do not guess, we do not panic, and we absolutely do not follow the herd. We analyze, we decode, and we trade with conviction. If this is your first time here, I want you to hit that subscribe button right now, because what we are about to go through together is the exact kind of deep dive that separates the traders who survive volatility from the ones who get wiped out by it. As of the New York Open this morning on March 19th, 2026, the precious metals complex is bleeding. And the narrative that most mainstream outlets are pushing, that this is just a normal pullback, is frankly dangerously incomplete. To understand what is happening right now, you need real context, historical context, and that is exactly where we are going to start. Think back to the gold and silver markets of 2220, when the pandemic panic first hit. Gold surged to an unthinkable $2,189 per ounce, while silver ran from below $12 all the way to $20. Fast forward to the geopolitical crisis years of 2022 and 2023, when the Russia-Ukraine conflict pushed gold back toward the $2,000 range with conviction, and war premium and inflation premium were both fully baked in. But here is what is fundamentally, structurally, categorically different about 2026. We are not in a world where gold is trading at $2,000. We are not even in a world where it is trading at $3,000 or $4,000. As of this morning, even after today's brutal sell-off, gold spot is still holding above $4,600. And let that sink in, because even the crash is happening at a price level that would have seemed absolutely science fiction just 3 years ago. This tells you something profound about the new baseline for hard assets in 2026. The floor has permanently shifted upward, and we are not going back to $2,000 gold. The question is not whether gold is in a bull market. The question is, how deep does this correction go before the next leg higher? And silver is the asset that I have been pounding the table on at Silver Signals for the past 18 months. And even at today's crushed price of $70.81, silver has more than doubled from where it was just 2 years ago. The structural story for silver is not broken by a one-day Fed-driven sell-off. It is, if anything, creating the entry opportunity that patient, disciplined traders have been waiting for. But let me be very clear with you. We are not blindly buying this dip, not yet. Because before we talk about entries, we need to talk about what caused this, what the charts are telling us across multiple time frames, and where the real danger zones are. On the monthly chart, the macro picture for both gold and silver remains undeniably bullish. Gold has been in a sustained parabolic uptrend since breaking above the $100 resistance zone in early 2024. And every single monthly candle since then has respected the rising 20-period moving average as dynamic support. The monthly structure tells us we are in a wave 3 extension on the Elliott wave count, the most powerful and persistent phase of any bull market. But even wave 3 extensions have deep corrective phases within them. A 5 to 8% correction on the monthly chart, like what we are seeing today, is textbook wave 4 behavior before a final wave 5 extension toward those analyst targets of $5,400 to $6,300 that UBS and JP Morgan are projecting by year end. For silver, the monthly chart shows a textbook cup and handle formation that has been building since the 2011 highs near $50, and we finally broke out of that multi-decade base in 2024 with a projected measured move that puts silver somewhere between $85 and $110 on the upside. Today's candle does not break that monthly structure. It is a wick, a painful wick, but a wick. Dropping down to the daily chart, here is where things get really interesting, because gold had been consolidating in a rising wedge pattern between the $4,150 and $4,150 range for the past 2 weeks. Wedges are inherently unstable patterns that compress price action like a spring and almost always resolve with a violent breakout in one direction. Yesterday, March 18th, the Fed delivered what traders are already calling the hawkish hold. The Federal Reserve kept rates at the 3.50 to 3.75% range with no cut, and signaled only one cut for the remainder of 2026. That was the pin that popped the wedge. Gold gapped down at the open, sliced through the $4,700 psychological level like it was tissue paper, and silver, which always amplifies gold's moves in both directions due to its smaller market cap and higher beta, dropped even harder. Silver futures lost 12% intraday, and that is not a correction, that is a liquidation event. On the daily chart, I'm watching several key levels with extreme precision right now. For gold, the $4,600 level is the line in the sand, where the 50-day moving average is currently converging with a major horizontal support zone that has acted as both resistance and support going back to November 2025. If we close a daily candle below $4,600, the next support cluster is around $4,134, which is a 23.6% Fibonacci retracement of the entire bull run. For silver, I need to see XAG USD hold above $68 on a closing basis, because below that, we could see a flush down toward the $63 to $65 zone, the 38.2% Fibonacci retracement level from the 2024 breakout. And these are not arbitrary numbers. These are where the big money buy orders are stacked in the order book. And that brings me to something I want to address very directly with you, because I see so many retail traders getting destroyed by this right now, and it does not have to be this way. What you witnessed this morning in the New York session open was a classic institutional liquidation hunt. The whales, the hedge funds, the prop desks, the algorithmic traders running billions of dollars, they know exactly where retail stop losses are clustered. Right below obvious round numbers and recent swing lows, $4,700 on gold and $70 on silver, those were the two biggest stop loss clusters in the entire market this morning. And when the Fed announcement hit last night, the institutional algorithms lit up. They drove price through those levels, triggering a cascade of stop-loss orders that turned into forced selling, which drove price even lower, which triggered more stops. This is not random. This is engineered. And once you see it, you cannot unsee it. The question is whether this was a genuine trend reversal or a bear trap designed to flush weak hands and accumulate at lower prices before the next push higher. And my read on the structure says the latter. On the 15-minute chart, specifically looking at the New York session this morning, silver opened with a massive gap down, immediately found sellers into any bounce attempt, and the intraday structure shows a series of lower highs and lower lows for the first 2 hours of trading. However, and this is absolutely critical, I am seeing early signs of absorption at the $68.50 to $69 zone. And what does absorption look like on the 15-minute chart? It looks like high-volume candles with very small bodies, big wicks to the downside, tiny real bodies. That tells you sellers are running out of ammunition, even as they are still trying to push price lower, and the smart money is quietly accumulating while retail is panic selling into the flush. For traders looking for a tactical entry on silver in today's New York session, I would not be chasing this move in either direction right now because the volatility is extreme, spreads are wide, and the risk-reward on impulse trades in this environment is terrible. What I am watching for is a confirmed reclaim of the $70 level on the 15-minute chart, specifically 2 consecutive 15-minute closes above $70, with volume declining on the retest. That would be my first signal that the liquidation flush is complete and that we are entering a consolidation phase. And from there, the first upside target would be $72.50, then $74. And above $74, I think you get a rapid snapback toward the $78 to $80 range, where silver was trading before this morning's capitulation. Now let us talk about the fundamental picture, because this is where Silver Signals provides analysis that you simply cannot get from mainstream financial media. The reason today's sell-off feels so violent and confusing is what I call the oil paradox of 2026. The Middle East is genuinely on fire right now, with confirmed strikes on energy infrastructure in Qatar and Iran over the past 3 weeks, and oil prices trading near $110 per barrel. Historically, this kind of geopolitical risk drives massive inflows into gold as a safe haven. And it did, as gold ran from $4,200 to nearly $4,900 in less than 60 days as the conflict escalated. But here is the cruel twist. High oil prices are also highly inflationary, and the Federal Reserve is laser focused on inflation. So when oil spikes, the Fed keeps rates higher for longer, and when rates stay high, the opportunity cost of holding non-yielding assets like gold and silver increases. The dollar strengthens, metals get sold. The DXY, the US dollar index, hit a 10-month high today, and when the dollar is strong, every dollar-denominated commodity becomes more expensive for international buyers, which crushes demand. This is the DXY inverse correlation that every precious metals trader must understand at a bone-deep level. But here is what gives me absolute long-term conviction on silver specifically, and why I think this sell-off, as brutal as it is an absolute gift for strategic accumulators. We are living through the most profound structural deficit in silver's modern history. The Silver Institute's latest data shows that global silver demand has now exceeded supply for the 4th consecutive year, and above-ground inventories are being drawn down. The demand side of this equation is not slowing down. It is accelerating, and for reasons that have nothing to do with jewelry or traditional industrial uses. Consider the 2026 AI infrastructure boom. Every single data center being built to power the artificial intelligence revolution requires massive amounts of silver for its electrical connections and conductivity applications, representing hundreds of millions of ounces of incremental demand that simply did not exist 5 years ago. Every solar panel installed, and the IEA projects over 600 gigawatts of new solar capacity globally in 2026 alone, requires approximately 20 milligrams of silver per cell. And when you multiply that across hundreds of billions of individual solar cells, you're talking about over 200 million ounces of silver demand from solar alone in a single year. Then, layer on top of that, the EV expansion. Each electric vehicle uses roughly 2 to 3 ounces of silver in its electrical systems, battery management units, and charging infrastructure. And with EV sales projected to reach 35 million units globally in 2026, that is another 70 to 100 million ounces of demand coming from the transportation sector. Annual global silver mine supply is approximately 900 million ounces. You do the math, the deficit is real, it is structural, it is not going away. No single Fed rate decision changes that equation. I also want to address something that I am seeing a lot of concern about in the comments. And this is a good moment to say, if you are finding this analysis valuable, if this is the kind of depth that helps you trade with more confidence, please smash that like button, drop your price prediction for silver in the comments below. I read every single one. And if you have not already subscribed to Silver Signals, now is the time. We do this kind of analysis several times a week, and you do not want to miss what we have coming up. The next video is going to cover the central bank buying patterns that are quietly happening beneath the surface of this sell-off, and it is going to change how you look at this market. Now let us talk about central bank activity and macro policy, because this is where the really sophisticated picture emerges. Central banks globally purchased a record amount of gold in 2024 and continued that pace through 2025, with China, India, Poland, Turkey, and Kazakhstan all as net buyers. The latest CPI data released earlier this month showed headline inflation at 3.8%, still well above the Fed's 2% target, and largely driven by energy prices and food costs. This is the stagflationary trap that the Fed is caught in. They cannot cut rates aggressively without reigniting inflation, and they cannot keep rates high without eventually breaking something in the broader economy. Historically, stagflation environments are among the most powerful setups for precious metals over the medium term, and the 1970s are the textbook example, where gold went from $35 to $850 during that decade's stagflationary crisis. We are not there yet, obviously. But the macro rhyme is unmistakable to anyone who studies market history. I also want to flag something about today's price action that should be on every trader's radar as a potential bull trap warning. Here is the scenario I am watching for over the next 48 hours. Silver finds temporary support in the $68 to $70 range. It bounces back toward $73 or $74. Retail FOMO kicks in, and traders who missed the sell-off pile in on the long side, convinced the worst is over. Then price fails to reclaim the $75 key structure level, rolls over, and we get a secondary flush down towards $63. I'm not saying that is the base case, but it is absolutely a possible scenario given the macro headwinds from the hawkish Fed and the strong dollar. This is why I keep telling you. We trade levels, not emotions. We manage risk, and we size positions appropriately for the volatility environment. In a market where silver is moving 12% in a single session, your position sizing needs to reflect that, half size at minimum until we see a confirmed structural shift back to the upside. So here is your action plan coming out of today's analysis. Number 1, do not panic. The long-term bull case for both gold and silver is completely intact. And number 2, do not FOMO into a bounce until you see confirmed technical structure on the daily chart, because the 15-minute chart alone is not enough, and you need the daily candle to close above key resistance before adding significant long exposure. Number 3, watch the DXY closely. If the dollar index starts rolling over from its 10-month high, that will be your earliest warning signal that the metal's counter trend rally is beginning. Number 4, keep position sizes at half your normal allocation until volatility normalizes. And number 5, stay focused and on the structural story. Solar, EVs, AI infrastructure, central bank buying, the deficit. None of that changed today. What changed today was short-term sentiment driven by one Fed meeting. Sentiment changes, but structure endures. That is your complete deep dive analysis of this historic day in the gold and silver markets from me, JIANG, here at Silver Signals. We covered the historical context, the multi-timeframe chart structure, the fundamental supply-demand imbalance, the macro drivers from the Fed and the dollar, the institutional liquidation mechanics, and the specific price levels you need to watch going forward. If you found value in this analysis, and I genuinely believe this is some of the most important content we have put out on this channel, I am asking you directly, please like this video, share it with one trader who needs to see this today, and drop your silver price target in the comments below, because I read every single comment and I want to know where you think silver is going from here. And if you are not subscribed yet, what are you waiting for? Hit that subscribe button and the notification bell so you never miss an analysis when the market is moving like this, because the next few weeks in gold and silver are going to be among the most significant of the entire decade. I will see you in the next video. Stay sharp, trade smart, and as always, trust the signals.